Imagine decoding the secrets of currency exchange with clarity and simplicity, empowering you to make strategic decisions with confidence. In this video, we're demystifying the basics of Forex trading, ensuring that every minute you spend with us adds incredible value to your financial knowledge. This isn't just another tutorial, it's your passport to unlocking the immense potential within the Forex market. What is Forex? Forex, short for foreign exchange, is commonly known as currency trading or FX trading. Occasionally, it is also referred to as spot FX. It's basically the trading of different world currencies. Unlike trading stocks, where you buy and sell pieces of a company, in currency trading, you're comparing and trading one country's money for another's. It's all about figuring out the value of one country's cash compared to another's. Why would you want to trade Forex? To kick things off, it's the most liquid market globally, running 24 hours a day, 5.5 days a week. Just to put it in perspective, it would take 30 days of trading on the New York Stock Exchange to match 1 day of Forex trading. This market provides excellent liquidity for traders. So, if you're looking to buy or sell any of the top 10 currency pairs, there's never an issue with those pairs not being available for trading. With such high daily volume, the average trader like you and me has absolutely no chance of influencing market direction. What are the advantages to trading Forex? Because the Forex market runs 24 hours during the week, there's very little gapping, a common issue in stock trading. When it comes to Forex, you only have a handful of currency pairs to choose from, a small basket compared to the numerous stock choices. Your Forex options are much narrower, which means less searching and analyzing. You can focus your efforts and concentration in a very specific field, so you can get to trading sooner rather than later. Adding to the perks, opening an account with a broker costs very little. So, we need an online platform to trade, it's all done through the internet. The cool thing is that most brokers offer unlimited demo platforms where you can practice trading for as long as you want without risking any of your own money. This is awesome if you want to try out different trading methods and ideas. It's commonly known as a demo trading, and there's no reason you can't have both a live and a demo account with the same broker. Just make sure not to get them confused. But please, be aware that trading on a demo account is nothing like trading on a live account. With a demo account, there's zero risk, so your emotions don't come into play at all. When is the Forex market open? It's a market that's open longer than it's closed. Forex trading follows the world's time zones and is divided into 3 major time zones. First up is Asia, covering New Zealand, Australia, Singapore, Japan, and more. This is the Asian session and is usually the quietest in terms of trading volume. Next is the European session, and as traders in the Middle East join in, all the major European centers, including London, eventually open. The European session is the main one, with the highest trading volume. Don't forget, London is the financial capital of the world, despite the common belief that it's Wall Street in the US. The last session to open is the US session, which can get pretty hectic, especially early in the day when major news releases can significantly impact the US dollar. So, we've got these 3 trading sessions, and they overlap as banks open for business in each major financial city, and the trading volume picks up. There are plenty of free online time zone clocks available that correspond to the different session times, so it's pretty easy to find sessions that fit your lifestyle. You can also find free custom indicators that clearly show the different session times on your trading charts. What do you trade in the Forex market? There are several currency pairs you can trade, but most traders stick with around 8 to 10 pairs, and that's more than enough choice. First up, we have what they call the majors. These are the most heavily traded currency pairs, and many traders are happy just trading 1 or 2 of these. The majors include Euro against the US dollar against the Japanese yen, Great Britain pound against the US dollar against the Swiss franc. Notice how they are all against the US dollar, so when traders talk about these pairs, they simply refer to them as the euro, yen, pound, or cable, and the Swissy. Next, we have what we call the second-tier pairs, Australian dollar against the US dollar against the Canadian dollar, New Zealand dollar against the US dollar. Again, these pairs are all against the US dollar, so they are simply referred to as the Aussie, Lunai, and Kiwi. The term Lunai actually comes from the first Canadian dollar coin. Then there are currency pairs simply called the crosses, and these involve non-US dollar pairs. Some of the more popular crosses include Euro against the Japanese yen, Great Britain pound against the Japanese yen, Euro against the Great Britain pound. There are quite a few others, but these 3 are probably the most popularly traded. Many traders prefer to trade their home currency as they feel they have a better understanding of it. So what do all the numbers mean when the currency pairs are traded together? The first currency mentioned is what they call the base currency, and it is being compared to the second currency, which is called either the quote currency or the counter currency. If the euro against the US dollar, you're quoted at 0.7125/0.7128. What exactly does this mean? The first figure of 0.7125 is called the bid price. The second figure of 0.7128 is the ask price. The difference between these two figures is called the spread. For example, if you saw a quote for the euro against the US dollar as 1.3864/1.38663, you would read it as 1.386/1.3866 by dropping the last digits. Then you can see that you have a spread of 2 pips. Where do you trade Forex? You'll need to open an online brokerage account to access the broker's trading platform. Most brokers offer demo trading where you can practice without risking real money. You don't need to deposit any funds with a broker to gain access to their demo platforms, as most are willing to let you try them without any obligation. This also gives you the chance to experiment with various platforms and see what you feel comfortable with. What about choosing a broker? Opt for one of the larger, well-known brokers. The retail Forex industry is relatively young and lacks the same regulations as many other traded financial instruments, due to the absence of central exchanges. Another recommendation is not to put all your funds into one broker, especially if you have a substantial amount. If you had $100,000 to trade, I wouldn't deposit all of it with one broker. Instead, I would either spread it among 2 or more brokers or keep funds in reserve and only deposit them if required. How do you actually trade Forex? In Forex trading, transactions are conducted in lots, which is the industry standard. However, some brokers, like Oanda, use units, which can be easily converted to an equivalent lot size. Lots come in various names, such as standard lots, mini lots, and micro lots. One standard lot represents 100,000 units of the base currency, expressed as 1.0 lot. One mini lot represents 10,000 units of the base currency, expressed as 0.1 lot. One micro lot represents 1,000 units of the base currency, expressed as 0.01 lot. The number of lots you can buy or sell depends on factors like your account balance, nominated trading leverage, and how much you're willing to risk on the trade. Margin, leverage, and risk. Margin is the available money in your trading account that you can use for trading. Forex is a leveraged instrument, meaning if your broker provides 100-to-1 leverage, you can control 100 units in a trade for every 1 unit in your account. Some brokers even offer up to 1,000-to-1 leverage. If a trade goes against you and you're over-leveraged, your broker may close the trade to protect their interests, even if it means your account is wiped out. Higher leverage allows you to control more currencies, but it's not a concern for me as I always control my risk on all trades. Risk refers to the amount of money you're willing to risk on a specific trade, stated in dollars. Important information for US-based traders. 1. Many US traders face restrictions due to government regulations, limiting US-based brokers to offer a maximum leverage of 50-to-1 on trading accounts. There are ways to work around this if you're a US trader, but it requires some research on your part. 2. Another US-specific regulation prevents traders from hedging, meaning you can't have both buy and sell trades open simultaneously on the same pair. Traders often hedge to manage positions, and some trading systems require trades in both directions simultaneously. There are workarounds for this rule as well. 3. The FIFO, first in, first out, rule in the US mandates that if you have multiple trades on the same pair in the same direction, due to the no hedging rule, you must exit them in the order you entered. The position size of each trade also plays a role. Refer to your broker for specific details, and many US traders find this rule frustrating, especially when they prefer a different exit order. Information on risk. If you engage in day trading, managing risk becomes a critical concern. I recommend allocating 2-3% of your capital for this purpose, a strategy commonly adopted by successful traders. Some even advocate for an even smaller percentage, emphasizing the benefits of minimizing risk to prolong your participation in the market. It's in your best interest to establish a physical stop-loss point. This is a predetermined level at which you exit a trade if things take an unfavorable turn. Having this safeguard in place ensures a controlled exit in case of unexpected developments. One significant challenge day traders face is the impact of news releases or unforeseen events. The Forex market is highly influenced by news, and there's a constant flow of information. The upside is that most news is scheduled, making it relatively easy to anticipate and plan for. Risk and correlation. The most evident and closely linked pairs in the Forex market are EUR/USD and USD/CHF, typically exhibiting an inverse relationship under normal conditions. Suppose you've bought EUR/USD in one trade and sold USD/CHF in another, risking 2% on each trade. In reality, you're exposing yourself to a 4% risk due to their high correlation. When you consider the scenario, if the pairs share a common currency and significant news affecting that currency emerges, the involvement of the other currency becomes less relevant. The market tends to move the dominant currency regardless of the other's role. This is a factor to keep in mind when assessing the overall risk in your trades. News and fundamental analysis. In the world of Forex trading, the majority of small retail traders, like you and me, often rely on some form of technical analysis. This involves trading based on charts, using various indicators, patterns, or setups of your choosing. On the other hand, there are traders who pay little attention to charts and instead base their trades on major news releases, essentially engaging in the fundamental side of trading. Every day, there's some kind of news affecting currencies in some way. The key is to figure out how the news will impact the currencies you're trading. The challenge with news releases is that, even though they typically follow a schedule, if you're not aware of them, they can catch you off guard. Stay informed to avoid surprises in the dynamic world of Forex trading. Technical analysis. A widely used approach to trading is known as technical analysis. This type of trading primarily takes place based on charts, leading to terms like chartists or to technical analysis enthusiasts. With technical trading, you have the flexibility to keep things as simple or as complex as you prefer. There are literally thousands of trading methods, and Forex trading forums are filled with discussions on these diverse strategies. On trading platforms, most brokers provide a range of chart options, including 1-minute, 5-minute, 15-minute, 30-minute, 60-minute, for hour, daily, weekly, and monthly charts. Risk-reward ratio. Imagine if we set our risk-to-reward ratio at 1:2 in trading. This means for every unit we risk, we aim to gain 2 units in return. To break it down in trading terms, if we have a trade with a 30-pip stop, we'd be targeting a profit of at least 60 pips, ensuring a 1:2 risk-to-reward ratio. If we opted for a 1:3 risk-to-reward ratio, our target profit in the same scenario would be 90 pips. Types of orders. Market order. In trading, a market order means you're swiftly entering or exiting a trade at the current market price. Keep in mind that in fast-moving markets, you might experience slippage on some platforms. This is important to be aware of if you miss the price at which you hit the buy or sell button. You may be asked if you want to go with the new market price. This situation, known as a requote, can be a bit frustrating at times. Buy stop or sell stop, these orders involve entering the market in line with the current trend. A buy stop order is placed above the current market price, anticipating that as the market rises, your order will be filled on the upward movement. Conversely, a sell stop order is set below the current price, and as the market falls, your order is filled on the downward movement, with the expectation that the market will continue to decline. Buy limit or sell limit. These orders are used when expecting a reversal against the prevailing trend. A buy limit order is set below the current market price, anticipating a drop to your entry level before the market potentially turns upward. Conversely, a sell limit order is placed above the current market price, with the expectation that the market will rise to your sell order, be filled, and then turn back downward. Traders might use these orders based on specific technical levels, such as Fibonacci or pivot points, where they believe the market is likely to reverse. How many pips is enough? On a $10,000 account with a 2% risk and tight stops, it's quite feasible to trade one standard lot. As a reminder, I usually mention that 1 pip on a standard lot is equivalent to $10. If you're trading currencies like the EUR, GBP, AUD, or NZD, this holds true. Now, if you manage to secure a 20 pip gain, that translates to $200. If you repeat this for 5 days, you'll accumulate a total of 100 pips or $1,000. Achieving a 20 pip profit per day can lead to solid results. Trading psychology. Most people experience emotions when dealing with hard-earned cash in trading, and these emotions can significantly impact decisions. The success rate is generally low. Fear of missing out on a big move or greed for more from a trade often leads to staying in a trade longer than necessary. Even if a setup appears perfect initially, it may not be the case, and traders sometimes end up buying at the exact high for the day. Introducing mind games. One of my favorite mantras, which I repeat to myself daily, is patience, courage, and discipline. Patience is straightforward, waiting for the right signal to enter or exit a trade. There's no need to fear missing out, as there will always be another opportunity. If in doubt, it's okay to stay out. While you may miss some good moves now and then, it's part of the game. Courage involves having conviction in your trading method and sticking to it through both favorable and challenging times. Knowing that your tested system works and following it diligently during all market conditions is crucial. Discipline is the glue that holds it all together. You have a tested trading method and specific rules within it. Discipline is necessary to adhere to these rules strictly. Without discipline, there's a temptation to change the rules midway, which can confuse emotions and lead to further issues. It's essential to get accustomed to having losing trades and accepting them as a natural part of the larger picture. Also, be comfortable with potential trades coming and going without your involvement. You can't catch every move in the market. Day trading or longer-term trading. If you're a day trader, it means you'll be actively entering and exiting the market within the same day or session. Once you wrap up your trading activities for the day, you won't have any open trades remaining. A situation often referred to as being too flat in trading lingo. Day traders may choose to operate on 1-minute charts, while others might prefer higher time frames. For instance, a day trader could use a 5-minute chart for entries and exits but base their trades on the overall direction indicated by the 1-hour chart, serving as a kind of filter. Day trading demands full-on effort and absolute focus. It requires a readiness to accept minor losses while consistently working to make gains in the market. Let's discuss extended-term trading, where you may hold onto a trade for hours, days, or even weeks. When I mention long-term, I'm typically talking about trading based on the 1-hour, 4-hour, or daily charts. Some traders might consider using the 1-hour and 4-hour charts as part of their swing trading strategy. In this style of trading, you're likely managing multiple pairs simultaneously, which can increase your overall risk, especially if the pairs with open trades are closely correlated, such as the EUR/USD and USD/CHF. Just be mindful of your overall risk exposure when you consider all your open trades. Trading off the 4-hour or daily charts offers a more relaxed approach to trading, suitable for individuals with regular jobs or family responsibilities that prevent them from being glued to the computer screen for extended periods. Keeping a journal or diary. Maintaining a detailed record of your trading results and other pertinent information is crucial. You can use a journal or diary, whether in the form of a handwritten exercise book or an online document. Putting pen to paper encourages thoughtful reflection on your actions at the time. You might also consider using Excel spreadsheets for a quick and accurate overview of your method's performance. If you're trading with a specific method, document its workings in detail for future reference, and record any modifications or adjustments you make along the way. Include details about your money management plan and any changes you implement. Highlight mistakes to avoid repeating them, and comment on your emotional state, technical issues, or any external disruptions that affected your trading. Disclaimer: the information provided about Forex trading is for educational and informational purposes only. It does not constitute financial advice, and should not be considered as such.